Portfolio Builder members, welcome to our SPY trading strategy webinar, which also covers the TBT trade. I have a short presentation with the current news. Then we'll look at how we pulled that $48 in profit from last Wednesday to today per contract we wrote. How doing that over and over again adds up to a huge return over time. And so let's get going. A quick shout out to some of the folks joining us today. Steve has become a regular attender alongside Mark, Henry, Harriet. It's an old customer of ours. Welcome for your first time into this program. A new name, James and Joanne Goodman. Welcome. Hank, welcome. We got Jerry, who's outperforming me, being in a show off. We may demo him in a little while later. And a new joiner today, Arnie. So thanks for your time, and really appreciate you having some time to join us live. Okay, so first slide, rule number one, never lose money. Rule number two, never forget rule number one. This is a time where buy and hold investors are doing better than us as we continue to make our measly 0.17% return every Monday, Wednesday, Friday, including rolling it over through the weekend. So we'll talk about why we've been playing it safe rather than being greedy right now. Larry Kudlow was on Bloomberg this morning, and of course we get two different stories depending on whether you're listening to the White House or the actual people creating the Federal Reserve's statistics. But his main point is that growth is not inflationary. He wants to stop the balance sheet reduction. He wants to lower the Fed rate 50 basis points. Why? When he says everything's so great in America, he's fearful of the recession in Germany and a slowdown in China. Last part of the interview on Bloomberg, they began talking about the trade deal. Says there is no March 1st deadline, although we all know there was for sure a March 1st deadline that was pounded in the news over and over again. There's no clue what's going to happen with the current tariffs, and it seems like they're just trying to push this past the next election. So now they're saying the deadline to see all this come together is 2025. So definitely some concerns about what's actually happening with the trade deal. Trump says the Fed should drop rates, stop quantitative tightening. Twitter's having an absolute fit about him continuing to, quote unquote, bully the Fed. The jobs report was strong today. Here's a quote from 2011 from Mr. Trump. The Fed's reckless policies of how low interest and flooding the market with dollars needs to be stopped, or we will face record inflation. But now he's advocating the exact opposite now that he's in the presidency. And you won't find many presidents that want to raise rates because it's always painful in the short term, even if it's, you know, what the doctor orders for long-term health. And here's his quote this morning. Despite the unnecessary and destructive actions taken by the Fed, the economy is looking very strong. The China and USMCA deals are moving along nicely. There is little or no inflation, and USA optimism is very high. And so this is the change in jobs. You can see that crash in 2008 is what we're all fearful of. But after a low print last month, we have another strong print this month. Expectations that the February cold weather outlier print would normalize in March were confirmed when moments ago the BLS reported the U.S. added 196,000 payrolls in March, higher than the 177,000 expected, and they revised February's from 20 to 33. Average hourly earnings are still rising, although a little slowdown. And so all the numbers in the jobs market looks strong from the broad look. If we dive down into it, we can see retail is continuing to get crushed, as well as manufacturing, and jobs are flowing into healthcare and services. So here's a summary of where the main growth was, and a lot of this was part-time jobs. So there's some critique about the real health of this growth, and we're seeing a continued destruction of the retail businesses. 3,000 more stores to close. Vacancies in malls continue to rise. And a little more, we did cover this recently, just yesterday, but Ray Dalio had a Bloomberg interview, and also Jamie Dimon had a interesting shareholder letter, and there's some overlapping themes that we're seeing from a lot of these elite investors, essentially calling for what Jamie Dimon says is not socialism, but he calls it social safety nets. Ray Dalio has some big points, mainly that the way the Fed works has really benefited the rich, but is not flowing down to your average Joe, and says this could strike a revolution. And he's also calling for a 30% crash in the dollar over the next 2 years. Now, he is in the game of selling primarily bond portfolios, so it's not a huge surprise that people of his nature, Jeff Gundlach, etc., are usually somewhat bearish on the stock market. So we always take that with a grain of salt. So some big overlap with Jamie Dimon and Ray Dalio's general message to try to get more capital flowing through these so-called social safety nets that would be bipartisan. Meanwhile, we have more rumors that there's substantive progress in the trade talks, and actually had some news wires out of China that supported that. So global markets are heating up. And so the big question is, with low inflation, are we at risk of a stock crash? So we go back to 1999, and you're going to see a very similar pattern from 1999 relative to today. You can see it, the inflation did start to pick up, but not until the crash actually started happening in 2000. So we look at the Dow. The big crash in 2000 was the NASDAQ. So this doesn't even give you a feel for how bad the losses were in the tech sector during that period. But you can see that leading into this period, they had tried to raise rates, lowered them back down after getting scared, raised them back up as the inflation crept in, and we got one of the worst crashes ever during that period. And so we pop up to today's inflation rates. We have some very low prints. So I think that it's fair to say that you can run into some pretty serious trouble whether inflation is too low or too high. Now moving into a summary of our trade from Wednesday through today. This can get a little confusing for everybody, so I just wanted to show it. Let me zoom in here. This is the trade we put on Wednesday. We were seeing something that's very odd, where the TLT and the SPY were both going up together for a considerable amount of time, which is usually not the case. They can go up over time together, but usually they're somewhat trading in the opposite direction. And so this was concern to put on a defensive trade. So this trade, if you look at the last trading price in this trade, this was the new covered call from Wednesday. You can see it was trading at 287.06 when we agreed to sell the covered call at 285. So off the offset, we're agreeing to take a $2 loss on the underlying in order to create a profit from the credit. So that's 256. So that works out to about a 50% or a 50-cent profit per share per contract we write. So in this case, there's 17 contracts. 17 times 50 would be the potential profit on this trade if we're wrong. If the S&P 500 jumps up higher, that's our baked into the cake profit. And so we'll look at a compounding calculator to see how well that adds up over time. But this is one of the few risk-free ways you can generate income and provide yourself with downside protection. So we had some protection from Wednesday to Friday. And like I said, we overrode what the market was predicting by doing the in the money covered call. And I was wrong. The market went higher and there was no need to be so precautious. So today we covered that for a loss on the covered call, but I'll show you the math. We still got that baked in the cake $50 profit on the underlying. And we've repeated the trade, a little less defensive, only a $1.69 of downside protection approximately. But now we have a bigger potential profit between now and Monday. Still playing it safe. So if we look at the math, Wednesday we sold the 285 strike when the SPY traded at 287.06 for a 256 credit. And Friday we covered that 285 strike when the SPY traded at 288.33 for $3.34. So we lost 78 cents on the covered call times 100. But at the moment we covered, we had a $1.26 profit from the SPY going from 287.07 up to 288.33. And so once again, it's important to remember we can't lose if the market's going up. And so we ended up with 48-cent profit per share times 100. And of course, that was times 1,700 or 17 contracts in our model portfolio. So now if I jump over to here, you can see how this all adds up. Looks like my calculator got reset. So if we look at the return on investment from playing it safe and doing it every Monday, Wednesday, Friday, it's amazing. It ends up with a 30% return over a period of a year. And we can generate a profit if the market's flat, down, slightly down, or up. Now, we don't want to be doing these defensive trades all the time, but right now, that's the current alert that we have out. Now, let's look at today's trade alert, and we'll see the market starting to finally agree with us in terms of playing it safe. If we look at the call option and put option today for expiration on Monday, we can see that there's a big flood of put options into this 287 strike, but there's still a good flood of bullish optimism flowing into this 290 strike. So let's look at the math of today's trade and the potential outcome. So if we zoom in, you can see once again we're agreeing to take a small loss on the covered call up front, but that is okay because the credit we're taking is greater. So we're agreeing to a $1.27 loss, but we're taking in a $1.69. So we're right around that $50 profit mark between now and Monday. Switch over to our portfolio. Now, I do want to point out that our return on investment will look slightly inflated every time we put on the covered call, especially if it's an in-the-money covered call. So in each update in the document, you'll see that I will screenshot our return in between covering the position. So that gives you your most true return on investment in that moment where you're covering, but before you roll over the position. So we started this right here. And you can see we've had to protect against a crazy crash, which was alarming. And of course, we didn't write the covered calls quite that aggressively on the defensive side. And then we missed out on a lot of the return on the upside. So what's the result? The result is a very boring but slowly growing portfolio that is defending against downside risk, but still collecting a very considerable amount of income every Monday, Wednesday, Friday. Now, just a quick review of how to follow this program. First step is to put a deposit into this blue area. So this portfolio has a $500,000 model portfolio, but you could follow it with as little as $30,000. You then control the asset allocation in this area. The default setting is 90% to target income, 0% in growth currently, 10% cash, and then if you wanted to, you could push this down to 80 or 70 and put a little bit of your portfolio into the TBT trade. Now that's optional. This is where we keep track of our stock buys and sells. If it's positive, it's a buy. If it's negative, it's a sell. This is where we keep track of our open trades and the number of contracts. So we can see our open covered calls right here. And then down here is where we close out the positions. Now again, for a lot of folks who don't quite understand this, a lot of people come look at this closed ROI and think that's something to do with our, win rate or something of that nature. But it's really the opposite. When you see 100% gain on one of these trades, you got to ask yourself, what happened to the underlying asset? Did it go down more than the covered call collected? So really the best way to judge how well you're doing and we're doing is to simply watch this figure slowly but surely grow. And so that's our main goal, is to have consistent nonstop growth with a lot of defensive protection built into our strategy. Now on the TBT trade, we've had some pretty crazy actions in the underlying asset. Essentially just this huge drop during the period we started doing this, as the treasury has just dropped a huge amount in a very short period of time. And so currently we are writing our strikes slightly above the trading price, as I think these rates are as low as they're going to go. Now that would of course be conflicting with what the White House is pushing for. So if we look at today's trade alert for the TBT, it was the 33.50, so just above the trading price for a nice fat juicy 0.81% ROI. And so this is a trade we're going to do every Friday for a long period of time, expecting that, let's zoom out on this. The big call is that we are about to start undergoing a period of reversal of low rates back towards more historical norms. And so if this just gets up to 5 to 6%, the TBT is going to be trading upwards of $140. So right now, that probably seems like a crazy idea when you look at the long-term picture of the TBT, which has crashed from 290 in 08 all the way down to 33 in 2019. So if the White House gets their way and rates really do drop, we could see some more volatility in this portfolio. But in the long run, I believe this is a very good strategy we can do every Friday for years and years to come. All right, so that's a summary of today's trades. So next Monday, we will have the next trade alert for the SPY. And on Tuesday, we have our high yield covered call strategy. So for those of you who have a little more capital to put to work, this portfolio costs $150,000 to build, but it's basically what's under the hood of the SPY. And by going to the top positions in the SPY ETF, we can get a much higher yield on these covered calls, and we can also aim our strikes a little more accurately on a per security basis. So this program only trades Tuesdays at 11 Eastern, followed by a webinar. Then on Thursdays, we have our emerging markets class. Same story, focusing on the emerging markets. It also has some exposure to the precious metals and one OTC stock, 10 cent. All right, so let's open this up for some Q&A now. I'm going to unmute the crowd. If anybody doesn't want to be unmuted, you have the power to mute yourself. We've got a lot of people piling in here. So if we get too much noise, I may have to only open a few people up at a time. All right, guys, welcome. You're all unmuted now. Okay, Steve has a question. What is the advantage of selling in the money calls versus slightly out of the money calls? So sure. Pull up a option chain. James and Joanne, if you guys do have any questions, let me know. You had a little bit of audio flowing through, so yeah, if we think the market's going up, we want to sell the strike that's farther up, then the market will travel, and then we can enjoy profit on the SPY going up, and we can also keep part of the covered call. But if the market goes down, we may lose more on the SPY. Even if it's an unrealized loss, then we have collected on the covered call. So when we are writing the strike below the trading price, that gives us protection to generate a profit even if the SPY goes down. So for the last few weeks, I've been a little paranoid perhaps, and we made less than we could have if we were writing the covered call above the trading price. So of course, right now we probably all wish we didn't write the covered call at all with a rally of this nature. But what happens when people start taking profits and it's traveling down for the next 3 months? We'll be the only game in town that's generating the same boring profit over and over and over again, while everyone else is starting to freak out about, is this the end of the rally, or is there more to it? So we're taking a little bit of the guesswork out of generating a return, and sure, we miss out on some of the big moves to the upside, but we can generate a profit in a flat or down market as well as an up market with the covered call strategy. And so for people who are in the 50 to 80s, you're not going to be in a situation where you could afford a 5 to 10 year period. Okay, so Steve, so if we write the in the money covered call, we're trying to protect our capital, bottom line. And so you'll see with this program and our audience, which is primarily retirees who need to protect capital, we will be overly paranoid with this program. Now, I do try to teach you guys the strategy, the method, how I'm picking the strikes, so that if you do want to take on a little more risk, you can. And we do have a member in here who's doing just that. He's taking the concepts, using the platform, playing with a little bit, and he's got a huge return just in the first 3 weeks of following this system. Mark says you're fighting the Fed, which is usually not smart. Sure, yeah, you could say that. I agree with that. I've been telling you guys that our general outlook is rates are low, Fed's dovish, but still, I'm still going to play it safe more often than not with this program. The difference is about collecting $100, maybe $125 if we play it aggressive and we have no downside protection. or we can have downside protection and make about 50 bucks. So we can still generate a 30% annualized return, collecting 50 bucks 3 times a week, 156 times a year, and experience very little losses if the market's traveling lower. So that's the reason for playing it safe. And I think you'll see that when the news flow does get a little negative and the market has some downside, that's when our strategy is going to really shine, and people who are a little too bullish are going to be taking some big losses. And we're really getting mixed signals. If everything's so great, they should raise rates. So why are they calling to lower rates? Why is all the there's a lot of confusion. The bond market's rates are going lower, the stock market's going higher. So most likely they're both a little bit off base, and I think they're going to revert to something that makes a little more sense. So we'll see how long this trend will go. I guess we've been calling a top in this current rally for about a week now, and so Steve is looking at technicals. We have 4 weeks at least before there's any kind of China deal. So what's going to feed the bull market from here? And so yeah, I'm a little skeptical that we're going to travel much higher right now without some sort of trade deal strike. And then if we do strike a trade deal and all the data starts to improve globally, are all of the central banks going to get back onto this rate hiking path that they promised us in 2018 and then suddenly reversed course, or at least said they're pausing? We've got quite a few new folks in here today, up to 15 people in the audience. Let's see. Self-muted. Anybody out there have some questions that's new to the audience? James and Joanne, I'm going to unmute you again. Okay, they got a lot. Okay, rep 120 on the basic program. Can you add 3 to 5 SPY options and get your info for the basic price? So I'm not sure what you mean on the add 3 to 5 SPY options. As for the pricing, the footer of each update has our pricing. The basic program is $9.97 a year, but you can call in and save $100. And from there, our prices go up, and so does the amount of capital it takes. So if you're trying to follow this program, which is a very high return, you still need 150K to build it. And so this portfolio is trying to generate around $5,000 a month of income. So this is our most expensive program, and it's really for people who have quite large portfolio sizes. The emerging markets program is a little less capital to get started, has a nice return as well. And then this is our basic program, which probably provides the most defensive ability. So if you're really concerned about protecting your capital and you still had a lot of cash, more than the 30K, this would still be the safest place to grow your portfolio relative to our other options. So for those of you who like a little more risk and you want a higher return and you have the cash, this strategy makes a lot of sense. But if you're more interested in just a safe, slow, steady strategy, you're going to have a hard time beating this because it has the 3 option contracts expiring every week. There's just no way to do that with any other security. Any other questions out there? Anybody want to have me pull up their spreadsheet and we can start filling it out together?
I would, but it's just all filled out, Jason.
Yeah, you're doing too good. Well, maybe I'll pull up your sheet just to show everybody. Okay, rep wants a phone number. Yeah, let me grab the phone number for you guys who want to call in and save. I'll put it up on the screen a little bit. So I got a quick question here. I heard you discuss your plan for market pullbacks the other day, buy VIX calls and or QQQ puts. Market goes down faster than up. So do you miss the move if you wait? How do you time that? So the VIX play, we can only buy 6 months of protection. So we're looking at a 3-month, we want to sell that call option before we get halfway through the time premium. So really with the VIX, if we go long the VIX, we're going to expect it to go higher for 3 months. So let's look at the VIX. This is our first line. Well, this is really our second line of defense. And so you can see on the monthly chart, when the VIX does really skyrocket, it tends to do it for 3 months. So right here, 1, 2, 3. Right here, 1, 2, and then it stayed up here for the third. 1, 2, 3. 1, 2, 3. 1, 2, 3. So yeah, we're not going to miss the whole move. But what I'm not going to do is predict a VIX crash or a VIX rally before it begins, and that's because you can see there are periods where it just goes down for a full year. So we can protect ourselves pretty well with the covered call every Monday, Wednesday, Friday, and that's just the best way to protect yourself from small volatility in the market. It's not going to be a great way to protect against huge drops. So that's our first line of defense, and we can play it safe and kind of predict volatility before it happens without losing money. So you can see with the trade today, I'm providing you guys with protection to your capital in a risk-free scenario. If the market goes higher, that's crazy. This is just crazy. You think this is going to go on forever? You're crazy. But we have a trade today where if crazy continues, we do all right. If this trend just keeps going higher and higher, great. And if it doesn't, we also do well. So covered call is the best way to protect your capital on the SPY because you can roll it over Monday, Wednesday, Friday. Now, it's not going to protect against something like this crash completely. And in fact, we'd like to make some money if we get something like that. So if we saw a move something like this one, that's when we would put the VIX on. So sure, we're going to be buying the VIX at a premium, and it's going to give us 3 months of strong protection. So that'd be the first line of defense. Now the QQQ trade can give us 2 years of protection. With a leap option. But I won't put that on until after the VIX is spiking. And I would like to see some sort of fundamental problem arising. So either corporations' earnings continue to sputter out, we get a sense that tariffs are going to be rose instead of a trade deal. That'd be a shock to the market. Or if the central banks all start talking about needing to raise rates. So I probably wouldn't look at adding that sort of protection until one of those 3 fundamental problems was arising. But in terms of just normal, hedge funds trying to screw with the markets, sure, the VIX is a good way to capitalize on that, and we'll jump into that when we see the trend. So that's a big advantage of being the little guy. You guys are the little tiny minnows in the great big ocean, and you can go with the flow of the ocean. And so that's how we can create these nice returns, protect our capital, and do it with a simple covered call. If you had $100 million to manage, you couldn't do this. There's no way you could be jumping in and out of the SPY so easily, and there's no way you could be writing this many covered calls so easily. So certainly this is taking advantage of being a small account size. We're still playing it very defensively, and yeah, that's kind of the general idea with how to protect. So we'll pay a premium on that VIX call, and we might be wrong. But I'd rather do that than jump into it and watch it just lose value. So I'm looking at a 9% position in the VIX with an in-the-money call option. And that's just because there's so much money trying to short volatility that it's hard to capture profits on the VIX. Okay, Hepler Group says, doesn't backwardation hurt you past 30 days? I don't quite understand that question. Do you want to rephrase that maybe, Hepler Group? So if anybody wants to join today, I know a lot of you are still on your free trial, but if you call Mike, 505-322-9884, he's actually one of our first clients from years ago. Used to be a doctor, a really nice guy. He has some discount codes for anybody who wants to call in and save some cash. Okay, so back to the question. Mark says there's a thesis that this melt-up phase has another 30% upside. Yeah, sure. So quite often before stock market crashes, you get a period of euphoria, and you know, the trend goes on longer than most people think possible, and the markets will be irrational. So sure, that's just not our job. We're not the young fellow who can afford to wait 10, 20, 30 years if we're wrong. So let's look at some major concerns for anybody who's over 50 and is trying to generate retirement income from their trading account. And so sure, you know, if we think about the big picture, the Dow's gone from 2,500 to 25,000. And in the long run, you know, I don't think 10 or 20 years from now, America's going to be some ghetto. It'll probably be a lot nicer looking than it is today. But what if you get a period of time where you have negative returns for several decades? You know, what if we're at 1965 and we're not going to break even till 1995? That'd be 30 years of your assets just depreciating. And sure, there's some rallies and some crashes, but that's the sort of risk you have if you just try to be long the stock market when it's clear the valuation is relatively high. So for our folks, it's much more interesting to play it safe. We can make money if the market goes up. We'll make less than everyone else, but we can also do well if the market goes flat or down. So that's really the name of the game with this one. Yeah, if Mike doesn't answer you today, he'll get back to you as soon as he can. Okay, guys? So.
Jason, on the spreadsheet under profit, is that an accumulative counting the
Credits? Yep.
credits? Okay.
Yep, so this will be the most boring program you've ever seen. Our goal is to just collect that tiny amount of interest 3 times a week, 52 weeks a year. You know, it's going to be the most boring thing you ever watched. You'll probably have a good idea of the trade before it comes out. You know, we know exactly what we're trading. We know exactly when we're trading it. We have a general idea of what strike we're going to cover. So, you know, what's important is that after you've followed this program for a year, if I disappeared, you would still understand how to do this. You'd still have your spreadsheet. You'd see for a full year of how we're reacting to the various news. You'd see how we're looking at where the market's betting with their short-term option volume. And so really this product, it sets you up for life. You can do this for the rest of your life. And there's no better asset than the S&P 500 SPY ETF in terms of a single security. And that's because it has the most liquidity and it has the best option market. So it gives you the ability to protect your capital and generate income. Let me pull up Jerry's sheet. He's been a little bit of a show off lately. So let's see what he's been up to. Oh, it's your Gmail, isn't it, Jerry? Yeah, there it is.
Yeah, I put it up there for you.
Right, this is so we did this live in a webinar for everybody, which was pretty fun. Jerry, you know, didn't like some of our, he didn't like Facebook, which, by the way, is doing very well for us this week. But we replaced Facebook with this VXXB, which is something like the VIX, but you can actually purchase shares of it. He kept Bank of America. We put in part of the gold play and the emerging markets into this category and put the TBT up here. So he's kind of got a smorgasbord of all our programs mixed in together and has been, in general, just riding a strike right above the trading price. So he's able to enjoy the underlying appreciation to a degree and the covered call income. And same thing, he's been managing his trades here, tracking it down below. Very good student. Very proud to see this in action. And, you know, seeing somebody actually break away from just following me exactly. $7,521 profit, and there's no dates right here. When did you get started on this? Like
I think it was 313.
313. Well, you got to be pretty proud of this. You're doing a great job.
Yes, I am. I'm really happy with the method here.
And so his strategy is very correlated to what we're demoing in our portfolios. And so he'll be able to add that important protection with the VIX and the QQQ and be able to protect these positions. This is a very popular trade. I think Steve was, he's got 13% on that. So a couple years ago, we were selling a product that was more like, you know, let's do a spread or something of that nature, a lot more advanced. And one of our favorite things to do is wait for volatility to spike and then just short it back down. And so this VXXB with the covered call is somewhat like what we were doing, but much easier to manage. And so I think he's actually generated a ton of his profit right from this position. But that position is a very speculative position. It's not, you know, it's not a real asset. You're not owning part of a company that will generate profits for decades to come. So it's not something we're going to put in our portfolio, but the same breath, hey, he's cleaning up with that one. In terms of the weighting, just a little education on how you can manipulate your target size. So these are color coded. So this is saying we want 10% of our total assets to flow into this green line. 70% into this blue group, but that breaks it down from there based on these weight levels. So by playing with these weight levels, we kind of backwards calculated what he'd already done. And so you can see what his target size is. So this will help him maintain the right ratio of each underlying equity. And if he were to suddenly say, all right, this is great, I have another 150K, you know, maybe he's got a lot more, who knows? Maybe he's got 350K hiding back there. Now he'll know exactly what to do. Oh, one of them there. Not sure what's going on there. Oh, did you manually? No.
Oh, hey, there's one thing I wanted you to, if you'd scroll down, scroll down.
Yeah, one sec. I'm just wondering why your trade alerts aren't. Okay, scroll down.
Yeah, yeah, keep going, scroll down and then to the right a little bit. And there's a ref there that I can't get rid of. See it?
Mm-hmm.
I don't know why that is.
I think you need a price. No. So we did screw with the program a little bit on this one. There you go. Now it's gone.
Okay.
Yeah. So this is a good example of somebody. Harriet asks if I know of a computer to use with spreadsheets that would cost under 300. Yeah, the Google Chromebooks are a good deal in that price range. I like to do refurbished, old school, really old refurbished laptops on Amazon. So if you type in refurbished laptop, you can get like an old school computer that's good for spreadsheets, terrible for video games. And that's the sort of computers I like to buy because I mostly live in spreadsheets. See, any other questions out there today? Anybody want me to demo their spreadsheet and we'll build it out from scratch? So I'm just clearing out all these current. All right, guys. Well, I think everybody's starting to see just how easy this is. It's, this is not a magic strategy where we're predicting the future. So it's most similar to you bought an apartment in a really nice hotel in New York, and then you're using something like the Airbnb app to rent it out for 2-night stays. And so sure, the value of the property is going to go up and down over time, but that's not really our big concern. Our big concern is, can we continue to rent out the room? And if so, we can make a nice income for a long time. You got to ask yourself, is New York going to be more expensive in 10 or 20 years from now when we're done doing this and we want to pass on the asset, or is it going to be less expensive? And of course, the answer is New York's going to keep growing when we look a decade or 2 decades down the line. So when you have that mindset, you can show up, you can do your covered call every Monday, Wednesday, Friday. You're not going to be obsessed with what the underlying asset's going to do, and you can generate income. All right, last chance for any questions. Otherwise, I'll hope to see you guys back on the webinar next Monday. We have a growing audience, and I'm really appreciating everybody taking the time to join our team. It'll be fun when we have hundreds of people doing this, and just slowly but surely playing the turtle strategy and growing your account.
Good stuff, Jason. Thanks a lot.
Hey, my pleasure. Thanks again, and I'll see everybody on Monday.
Bye now.